I'm going to tell you something that took me way too long to figure out, and the delay probably cost me a decade of my life. When I was a young lawyer in Los Angeles working at a good firm billing respectable hours, making what felt like serious money in those days, I thought I was building wealth, I really did. I'd look at my bank account growing month after month and think, this is it. This is how you get ahead. And I was completely, perfectly, embarrassingly wrong. Let me tell you what I was actually doing. I was renting myself 8 hours a day, 10 hours a day, sometimes 12. I was converting my irreplaceable hours, the only currency that actually matters when you're 99 years old and looking back, into paper money that I'd then spend on a nicer apartment, a better car, dinners that I can't even remember now. And the cruel joke was that everyone around me was doing exactly the same thing and calling it success. My parents were proud. My colleagues were impressed. The whole system was designed to make me feel like this was the path. But you know what nobody told me? The mathematics were rigged. Income equals hours multiplied by rate. That is the equation. Want more money, work more hours, or negotiate a higher rate. Both have absolute ceilings. There are only so many hours in a week. And even if I could bill $1,000 an hour, which almost nobody can, I'd still be trapped because the moment I stopped working, the income stopped. It is that simple and that brutal. I remember sitting in my office late one night, probably my mid-30s by then, and suddenly seeing it, really seeing it. Every single dollar I'd earned had required me to show up and produce. If I got sick for a month, if I wanted to take time off to think, to read, to learn something new, the income machine stopped dead. That is not wealth. That is a fancy version of hourly employment. I owned nothing that worked while I slept, nothing that compounded independently of my physical presence. I'd spent a decade building a prison that paid well. Now, let me contrast that with something Warren figured out much earlier than I did. And this is probably why he ended up wealthier than I did, despite us being partners for 60 years. Warren understood from his 20s that the goal wasn't to maximize his hourly rate. The goal was to own things that generated returns whether he was working or not. He started building an investment portfolio when he was barely out of school. Modest amounts at first, but it was compounding. While I was billing hours, he was building capital that worked for him. And here's what really gets me when I look back. For the first 10 or 15 years, I appeared to be doing better. My income was higher, more stable, more impressive to talk about at cocktail parties. Warren was scraping by on much less, reinvesting everything, living in a small house, driving an old car. People probably thought he was struggling, but he was building something I wasn't. He was building assets that multiplied his efforts exponentially while I was just trading time in a linear equation. Let me tell you about the moment things started to change for me, because this is instructive. I made some early real estate investments, small stuff, nothing dramatic. Apartment buildings in decent California neighborhoods, and for the first time in my life, I experienced passive income. Rent checks came in whether I went to the office or not. The properties appreciated whether I was thinking about them or not, and suddenly I understood what Warren had been building all along. You know what that feeling was like? It was like discovering I'd been swimming upstream my entire adult life, and finally someone showed me there was a downstream. The properties weren't making me rich, not yet, but they were working independently. They were compounding, and that changed everything about how I thought about work and money and time. Now, when Warren and I started really working together, building what eventually became Berkshire, we made a very conscious decision. We weren't going to buy businesses that required us to show up every day and manage operations. We wanted businesses that generated cash flow without consuming all of our time. And you know what? We gravitated toward insurance companies. People thought we were crazy. Let me tell you why insurance was so brilliant. Because this illustrates the principle perfectly. Insurance float is one of the purest compounding mechanisms ever invented. Policyholders pay you premiums today. You hold that money, invest it, let it grow, and eventually you pay out claims with dollars that have been working for you the entire time. If you underwrite properly, if you avoid the stupid mistakes that sink most insurance companies, You end up with a permanent pool of other people's money that compounds forever. And here is the beautiful part. The insurance companies don't need Warren and me to show up and sell policies. We're not adjusting claims. We're not underwriting individual risks. We hired competent managers to do that. Our job was to allocate the capital they generated. That is maybe a few big decisions a year, not 40 hours a week of billable time. We built a machine that compounds with minimal human input from us. You know what else we did? We bought Candies now. People always talk about that investment, but they miss the point. We didn't buy C's because we had some brilliant insight about the candy business. We bought it because we understood that every time someone in California bought a box of chocolates for Valentine's Day or Christmas and bought C's instead of some other brand, that preference compounded. The brand became a little bit more valuable, a little bit more entrenched in culture. And you know what we had to do to capture that value? Nothing. We hired good managers. We gave them sensible instructions. And then we got out of the way. The business threw off cash year after year while Warren and I were reading, thinking, looking for the next opportunity. It worked while we slept. That is ownership. That is compounding. That is the opposite of renting your time. Let me talk about something that people really struggle with, and I struggled with it too. The patience required is inhuman. I'm not exaggerating. The first 5 or 7 years of building compounding assets feels like absolutely nothing is happening. You're putting in the work, making small investments, building slowly. And meanwhile, all your friends who took high-paying jobs are buying houses, taking vacations, driving nice cars. You look like you're losing. I remember watching some of my law school classmates make partner at big firms. They were making serious money by their early 30s. I'd shifted to investing by then, and my income was much more modest. On paper, they were crushing me. And you know what? That comparison almost broke me. The social pressure to earn more now, to look successful now, to keep up with your peer group, it is enormous. Most people cave to it. They go back to renting their time because they can't handle looking poor while their friends look rich. But here is what happens if you can push through that psychological warfare. Around year 8, year 10, year 15, the compounding starts to become visible. The assets you've been building are now generating income that rivals what you used to make trading time. Except you're not working 40 or 60 hours a week for it. It is just happening. And then, if you can make it to year 20, year 25, something magical occurs. Your assets are generating more than you could possibly earn hourly, no matter how expensive your time became. I watched this exact pattern with Warren. By his 40s, the compounding of his investments had reached a point where his net worth was growing faster from the returns than from any new capital he could add. That is escape velocity. That is when you've broken free from the time for money trap. And from that point forward, the gap just widens exponentially. You know what the tragedy is. Most people never make it to year 15. They get impatient around year 5 or 6. They see some new opportunity that promises faster returns. They sell what they've been building and chase the shiny thing. They reset the compounding clock to 0. I've watched this happen hundreds of times. Smart people, capable people, who just couldn't sit still long enough to let compounding work. Let me tell you about the biggest mistake I see people make, and I made this one early too. They confuse ownership with freedom, but they pick the wrong kind of ownership. They start a business, which sounds like they've escaped employment, but they've actually built themselves a more demanding job. If they stop working for 6 months, the business collapses. That is not an asset. That is self-employment with extra stress. The test is simple. Can your asset generate income for 6 months while you do absolutely nothing? Not work from a beach, not check in occasionally, literally nothing. If the answer is no, you don't own a compounding asset. You own a time-consuming job that might pay better than employment, but still traps you. I learned this distinction painfully with my early investment partnerships. I structured them requiring constant attention, reviewing positions, meeting with partners, analyzing opportunities. The returns were good, but I was trapped identically to how I'd been trapped as a lawyer. Different trap, same prison. I was still renting my time to the partnership. The breakthrough came when I realized the goal wasn't making the most money possible. The goal was building structures that made money while allowing me to think, read, learn, pursue whatever interested me intellectually. And that realization changed everything about how we structured Berkshire. We bought businesses with excellent managers who didn't need us interfering. We avoided businesses that required constant capital allocation or hands-on management. We built systems designed to compound for decades with minimal intervention from headquarters. People sometimes think that is lazy. It is not. It is understanding that your attention is your scarcest resource and you need to protect it ruthlessly. Let me give you a concrete example from outside my own experience, because I think it illustrates this better than anything I can say about myself. I knew a woman who spent 20 years building a portfolio of small commercial properties. She worked a regular job she didn't love, saved aggressively by living way below her means, bought properties methodically when she found good deals, and for the first decade she drove a 15-year-old car while her friends drove luxury vehicles. She lived in a modest apartment while they bought big houses. You know what happened? 25 years later, her rental portfolio generates more monthly income than she ever made working. It requires maybe 10 hours a month of her attention. She is financially independent in her 50s, while her friends who out-earned her for 2 decades are still trapped in corporate jobs they can't afford to leave. The mathematics worked exactly as predicted. No luck, no special connections, just patient application of compounding principles. Now, let me address something that keeps people trapped even when they intellectually understand all of this. Society actively punishes asset building in the short term while rewarding time rental. Your parents want you to get a prestigious job. Your spouse wants the lifestyle that comes with a good salary. Your neighbors judge you by your current car and house. All of these social pressures push you powerfully toward trading time for money, even when you know it is the inferior path. I felt this pressure. Warren felt it too, though he seemed better at ignoring it. There were years in my 30s where I made significantly less than my law school classmates, and people, even people who cared about me, asked if I was okay. Was I having trouble finding work? Had something gone wrong? The assumption was that lower income meant failure. Nobody could conceive that I was deliberately accepting lower income now to build assets that would compound into wealth later. You know what helped me resist that pressure? I started thinking in terms of inversion. Instead of asking what I should do to get rich, I asked what stupid mistakes keep people poor despite high incomes. And the answers became obvious. They interrupt compounding by chasing excitement. They consume windfalls instead of reinvesting them. They optimize for current income instead of future wealth. They compare themselves to peers on salary instead of on compounding trajectory. Once I framed it that way, the path was clear. Don't make those mistakes, build slowly. Stay within my circle of competence. Reinvest relentlessly. Ignore social comparison. Let time do the heavy lifting. It wasn't complicated. It was just hard because it required going against every social instinct and cultural message. Let me tell you what life actually looks like once you've escaped the time for money trap, because I want you to understand what you're working toward. You wake up and your assets have made more money while you slept than most people make in a week. You say no to opportunities that would consume your time, even lucrative ones, because you understand opportunity cost viscerally. You focus on problems that interest you intellectually rather than problems that pay immediately. But here is what surprised me about this state. It is not primarily about the money, though the money is certainly wonderful. It is about control of your attention and your time. When you're trading time for money, someone else controls your schedule, your priorities, your focus. When you own compounding assets, you control how you spend your days. And the quality of your life is ultimately nothing more than the aggregate quality of how you spend your days. You know what the other surprise was? Once you're not trading time for money, you actually think more clearly about everything. You're not making decisions based on immediate income needs. You can wait for perfect opportunities. You can say no 99 times and yes once, which is exactly how you should be allocating capital. But you can only do that if you're not dependent on this month's income to pay this month's bills. Let me talk about something I see constantly that breaks my heart. People in their 50s and 60s who made excellent money their entire careers maybe 300,000, 400,000 a year, and they've got almost nothing saved. They're still showing up to jobs they hate because they can't afford not to. And they're wondering what went wrong. What went wrong is simple. They earned a lot, but they owned nothing that compounded. Every raise led to lifestyle inflation. Bigger house, nicer car, fancier vacations. They converted their high income directly into consumption. And now they're trapped with a lifestyle they can't reduce and no assets generating passive income. That is the time rental trap at its most brutal: high income, zero assets, complete dependence. Meanwhile, I've known people who never made more than 60 or 70,000 a year who are financially independent because they built assets early. They bought rental properties. They started small businesses that systemized. They invested in index funds and never touched them. They lived below their means and let compounding work for decades. The income difference was huge. The wealth outcome reversed the income because one group traded time and the other group built assets. You know what Warren and I did with Berkshire? That exemplifies this principle better than anything. We held winners forever. See's Candies we've owned for over 50 years. Coca-Cola we bought in the 80s and never sold. Our insurance businesses we've held through multiple economic cycles. Not because we're geniuses, we held them because we understood that compound interest requires uninterrupted time to work its magic. Every time you sell and start over, you lose all the exponential growth that comes from letting winners compound. That is why our investment philosophy looks boring to outsiders. We find wonderful businesses run by excellent managers. We pay fair prices, and then we do nothing for years or decades. The doing nothing is the hardest part for most people. They feel like they should be optimizing, rebalancing, making changes. But that activity usually just interrupts compounding. Let me give you some very practical guidance because I don't want this to just be theory. Starting today, track how you spend every working hour for a week. Not obsessively, just broadly. Hours trading time for money, hours building compounding assets, hours on maintenance and rest. Most people will discover they're spending 95% of their working hours renting time and 0% building assets. That ratio has to change. Start with 5 hours weekly if that is all you can manage. Pick one skill or knowledge area where you're genuinely competent. Not where you think you're competent, where you have demonstrable results. Figure out how to package that into something that can scale without consuming proportional time. Build it methodically while maintaining your current income. And here's the key. Don't quit your job on day one. That is not rational. That is gambling. Keep your income while you build. Nights, weekends, whenever you can carve out time, it'll be exhausting. You'll want to quit. Your friends will be out enjoying themselves while you're working a second shift building your asset. But this is the price of admission. If it were easy, everyone would do it and the returns would be zero. You know what I wish someone had told me when I was 25? Your time is your only non-renewable resource. Money you can make back, reputation you can rebuild, health sometimes recovers. But time spent is gone permanently. Every hour you rent to someone else is an hour. You cannot invest in building assets that compound. The opportunity cost isn't the money you're not making today. It is the compounding you're not experiencing over the next 30 years. Let me close with something that still bothers me when I see it. Young people, smart people, taking prestigious jobs at consulting firms or investment banks or law firms, 80-hour weeks, big paychecks, impressive titles, and they think they're building wealth. They're not. They're renting their 20s and 30s to someone else at a rate that feels high but is actually catastrophically low when you calculate the true opportunity cost. Because those are the years when you have energy, health, time, and compounding on your side. Those are the years when you should be building assets that will compound for the next 40 or 50 years. Instead, they're burning those irreplaceable years generating income they'll spend on consumption. And by the time they realize the math doesn't work, they're 45 with a lifestyle they can't afford to reduce and no compounding assets to provide an exit. If you're sitting here thinking, but Charlie, I need the income from my job, I can't just stop. I hear you. I'm not suggesting you quit tomorrow. I'm suggesting you start building something on the side, 5 hours a week, 10 hours a week, whatever you can manage. Build something that compounds even if it pays almost nothing initially. Because in 10 years, that thing you built might be generating more than your job. And in 20 years, it might have compounded into genuine wealth while your job, no matter how prestigious, would still just be trading time for money. The mathematics of compounding are simple but not easy. You put in consistent effort over long periods. You don't interrupt the process. You reinvest the returns. You stay within your circle of competence. And you let time do the heavy lifting, nothing complicated. But it requires patience that most people don't have and discipline that society actively works against. I'm 99 years old and I've watched this pattern repeat for 7 decades. The people who achieve real financial freedom, the kind that provides actual control over their time and attention, are almost never the ones who optimize for maximum short-term income. They're the ones who accepted lower income in their 20s and 30s to build assets that compounded through their 40s, 50s, and beyond. And here is the final thing I want you to understand. The biggest enemy of compounding isn't lack of opportunity or starting capital or even bad luck. It is impatience. People build something to modest success, get bored or impatient, sell it to chase something shinier, and reset the compounding clock to zero. I've seen this destroy more wealth and market crashes than bad decisions than anything else. So if you take nothing else from what I'm telling you, take this. Stop renting your time. Start owning something that compounds. Stay within your circle of competence. Protect your downside. And once it starts working, for the love of God, don't interrupt it. Let time and mathematics do what they do best. That is not a sophisticated strategy. That is just respect for arithmetic. But respect for arithmetic, applied patiently over decades, is how ordinary people build extraordinary wealth.